What is up? It is John Fibonacci here, and I want to show you how I use the break of structure. All right, so this is the first video I've ever done specifically on structure, and when the video's over, you'll kind of understand why, like, I don't really teach the break of structure. So to me, like, traders who like to look at structure, there's a lot of different things that you can do with that, and I only look at one specific break of structure. All right, so this can be seen on a line chart, candlesticks, bar chart, whatever, and that's it. So I know a lot of you have heard me say before, like, I'll be explaining something, a certain setup or a trade, and I'll say, and for those of you who like break of structure, you see that here. And that's really the only time I ever talk about it. All right, so I'll go ahead and kind of make it, I guess, more formal, if you will, a more example, specific use of the break of structure. And it's kind of similar to the Wyckoff schematic. What I mean by that is I only look for certain Wyckoff patterns or pattern, and that one is the accumulation and then the break of structure and then the return to accumulation to then mark it up after that, something like that. And you'll see that here, all right, in a way, but it doesn't always have to be consolidation. All right, so a lot of what I do is pretty complex. I think a lot of you have been seeing that, especially for the new folks, that yeah, it can get very complex. All right, so anyways, let's just jump into it, and here we go. So basically, this is how I view a reversal. Now, of course, what I'm going to point out to you, it's kind of similar to the divergence, but we're actually not comparing anything here like that. We're just looking at the highs and the lows that are forming here. Okay, so what we're looking at on the downtrend, okay, so think about the market downtrending. You have a series of lower lows and lower highs. Okay, so you see that here where you've got highs, right? I didn't put the lows on because that's not what's important, because a lower low, that's fine. But when you have a high and then a lower high and then a lower high, you finally get that break of structure here. So now you have, instead of a lower high, now you have a higher high. Okay, so when you have candles that start closing above the previous high, then that to me would be a break of structure, and that is important. So say, for example, like the indices, you guys know I like to trade like 5-minute, 15-minute, 1 hour on the indices. And so, like, for example, I would want to see something like this if we're inside of a higher time frame area where I would expect a reversal to happen. So say we're at a daily, I don't know, Fibonacci level, or a daily institutional candle, and I'm expecting higher pricing on this particular day, then I'll say, okay, if we get a reaction on the higher time frame here, then I'll look for a small time frame setup like this. So I'll wait for that break of structure and then wait for that first retracement lower. Okay, so that first retracement lower, all right, that's where I start to look for smart money concepts. So if we have an institutional candle, I might see what the market wants to do. I mean, each setup is going to be different, you know, so it kind of just depends. All right. Or if we may not have an institutional candle, we might have mitigation. I didn't put that on here, but we might have mitigation. There could be an imbalance. That imbalance, if we don't have one, that's fine, but if we do have one, that's even better. That's higher probability, especially if that imbalance lines up with either a mitigation or lines up with institutional candle or lines up with an 80 or 20 level, something like that. it makes that imbalance a lot more powerful. All right. With that being said, you do have like, I'll look for an 8, 5, or a 2 level. That's really more for the indices, the 8, 5, or 2 levels. It does happen in Forex though, so don't get me wrong. Okay. But the indices, I love tailoring the entries to an 8, 5, or a 2 level. All right. But again, it does happen in Forex and commodities and everywhere else. You'll see the 8, 5, or 2 levels. And this is why I give homework. This is why I want you guys to back test, so you don't just take my word for it and you really start to see this type of stuff in the price action. All right. And of course, this kind of goes without saying for me personally, but since I'm teaching you guys, I want to be thorough and kind of get through all the details. So for me, it's automatic, but for those of you who are in the beginner stages, it's been a year or less for you and things like that. Then I want to make sure I incorporate that with the Fibonacci levels, that these retracements like the institutional candle imbalance, yada, yada, has to happen at a Fibonacci level of 50% or lower. So preferably the 618%. Or 786%, something like that. As long as it's 50% or lower, then I'm content with that. So a lot of the things that I do at this point in my career, again, I'm heading into my 7th year of trading. So a lot of the things that I do now, I've been doing for a while. So it just comes as a habit. And I'm not saying that to brag or anything. I'm just saying, like, when you really focus on this stuff and really study it and make it a habit, then it'll come secondhand nature to you as well, hopefully. I believe it will. All right. So I don't see a reason why not, but it's just practice, repetition, and things like that. All right. So there's only 2 examples here. I'll show you the first one, S&P. On the 1-minute chart, actually. So go ahead, look at this chart. I'll rewind it just for a second, just to kind of see or show you this one more time. Again, lower highs, lower lows, and then finally a break of structure, and then that first retracement lower. Okay, so I'll go ahead and show you the chart again. Here it is. If you want to go ahead and pause the video here to essentially look for what it is that I'm about to show you, then go ahead and do that now, and then look at the chart and wait a couple seconds and go from there. All right. All right. So I don't know if you paused the video or not, but here we go. So again, looking at lower lows and lower highs until you get a break of structure where you finally have a higher high instead of a lower high. Okay, so here it is right there between 11 and 11:30. Actually, well, right before 11 up until about maybe 11:15, something like that. You have a lower low and then finally a higher high right there. So once that higher high forms, that's when you start looking for a retracement lower. And so I didn't put this into the slides, but we do actually have a well, you can eyeball, let's say we're going to do a Fibonacci level. All right, from the low to the high. Let me just use the mouse real quick. From the low to the high, obviously this is probably near the 618 level, and then if you look right here, 3682, so that's why there's a 2 here, because this is a 2 level. All right, 82 would be considered a 2 level. All right, so right in there, and then look at the market, how it responds, and it comes and it takes out all these highs in the afternoon. So from 3682 up to like 3695, it's about 13 points, something like that. So that's not bad. That's not bad. 13 points doesn't, it may not sound like a lot, but on the micro E-mini futures, it's $5 per point. So 13 times 5 would be like 80, I think. 5 times 10 is 50 times, and then plus 15, 75. No, 65. I think. I don't know. I'm not that good at math. This is why I have to have calculators and stuff like that. Anyway, it's 13 points at $5 a point per per contract. So if you have 2 contracts, then it would be $10 a point, and so on and so forth. All right. And there it is. So the same is for trading short. When the first low is broken with a lower low, I will look for a retracement to the upside with the same concepts to enter a short position. The point basically of this whole video is that I need more than just a break of structure to qualify for a trading opportunity. All right. So it's basically the same exact thing except inverted or flipped if you want, where now instead of focusing on a high being broken, now we're looking for previous lows to be broken. And we see that here in the chart where you have the low and then here, let me just do this, higher or a high, low, higher low, higher high, and then boom, this is your break of structure. You have a lower low and then that first retracement to the upside or that first retracement higher, again looking for other, I mean these as well, but like looking for whatever the market may give us. I'm not forcing the market to do anything. I want to allow the market to tell me what it wants to do and just kind of go from there. So there it is. All right. And so I'll show you the shorting example. Again, if you are one of the people who want to pause the video here in order to look at the chart a little bit longer, then go ahead and do that now. And then we will come back to it in just a second. All right, so here is your shorting opportunity. Again, we're looking for lows being taken, right? A lower low forming, and then that first retracement to the upside to then enter a short position to go lower. All right. So right here, you see that break of structure, and then the market rallies to the upside as a retracement, and it hits a institutional candle. For those that might be a little bit confused, it's this up candle here, up candle before the down movement that breaks structure, and then a return to that, again the open, and then the candles are respecting that level. This is NASDAQ. All right, and then market makes a lower low, retraces again, and then makes a lower low. So there was an opportunity to exit maybe at this low. I don't know like what's beyond the chart, so I don't know like maybe why the market went all the way down here, but nonetheless market eventually does this. All right, but nonetheless, this is hindsight. We didn't live trade this, so this is for example purposes. But yes, those first retracements after the break of structure are considered low risk trades because the market is already telling you potentially which direction it wants to go. All right, so again, just to kind of wrap this up, it really depends on a lot of things, higher time frame analysis, low time frame analysis, or even, what I like to do is match, if the higher time frame is bearish and the low time frame is bearish, then that gives the lower time frame trade a higher probability of being a winning trade, allowing or a higher probability for allowing the market to go the way we want it to go. All right. So again, this is how I use break of structure. I really don't do anything more than that. That's really about it, outside of the divergence, but we've already done lessons on that. There's already videos on that. We don't really need to cover that here. And that is pretty much going to be it. So no reason to keep the video any longer than it should be. And that's going to be a wrap. All right. So with that being said, I hope you have a blessed rest of your day, and I will see you in the next video.